Hello, everybody, and welcome to Public Live. I am your host, Kinsey Grant, and you picked the right way to spend the next 20 or so minutes understanding what happened during the first half of this very volatile year to better determine what we might expect in the second half of 2022. And I know it's difficult to believe that we are already at the halfway point of this year, but you better believe it, because come Friday, we are officially in H2. So what happened in H1, you might ask? Well, the S&P 500 is down roughly 20% since we rang in the new year. The VIX Volatility Index is, on the other hand, up about 75% over the last 6 months. And if you're anything like me, investors are trying to suss out what comes next after a tremendously uncertain start to the year. So to do that today, we have two fantastic guests from the iShares team, Christy Akulian and Nick Morales from iShares America's Investment Strategy. Christy, Nick, welcome to Public Live. I'm so glad that you could join me today.
Thanks so much for having us, Kinsey.
Yes, of course. Now, I would love if you guys could just give a brief introduction, if you don't mind. Want to just say who you are and what you do?
Sure, I'll go ahead and start. My name is Christy Akulian, and I'm a senior investment strategist on the iShares team. So I work with investors of all different stripes, from end investors to institutional, just in thinking about ways that they can shape their portfolios for this sort of macroeconomic and the events and things that are on the horizon.
Yeah, my name is Nick Morales. I sit on the iShares investment strategy team as well. I really focus on a lot of the research that we're going and doing on the team, as well as a lot of the content that we're putting out, and excited to go and be here talking about the first half of the year and what we expect for the second.
Absolutely. And I'm so thrilled to have you both here as well. I think between portfolio strategy, content research, all of this great stuff to set us up for really, I think, some fantastic insight. And I think we should go ahead and get started with all of that right now. I would love to kick things off by just spending a little bit of time recapping what happened in the first half of this year. I think that, I'm no fortune teller, but I do think that volatility is certainly in the running to be Merriam-Webster's word of the year for 2022, at least if anybody in this conversation has a vote. So I'd love if you could help contextualize a little bit the volatility that we saw in the first half of this year.
Yeah, I can take that. I think that the word that would probably be the runner-up for volatility would maybe be unprecedented, because I think that's the question that we're getting so much from the investors that we talk to. And I guess I would say, the first thing I'd say here is that it's not necessarily unprecedented, right? So there's an old joke in finance that the most dangerous words are "this time is different." So I hesitate to use the word unprecedented, even though I know a lot of people are applying it right now. But I would agree that what we've seen so far is really unusual. So, I think we actually need to step back a little bit even before the start of 2022, just to get a sense for how unusual things are. And I think that one of the most unusual things about the particular market cycle that we're in right now is just how quickly it's unfolding, right? So we had the fastest ever bear market and recession in 2020, and that was followed by the fastest ever recovery. So, I know it feels like we're in this period of really high volatility right now, which we are, but it's important to remember that the volatility back then in 2020 and even in parts of 2021 was actually much, much higher than what we're experiencing today. By some metrics, if you're looking at the VIX, for example, it was almost 3 times higher in 2020. But the thing is, I don't think a lot of investors really experience that in quite the same way, because after a really quick bottom, the market was mostly going up. Right. So I think that that's really, it's a very different scenario than what we're seeing right now. If anything, I guess, what has been unprecedented, it's been how quickly risk assets, things like stocks, really recovered in the wake of COVID. But to bring it back, I guess, and fast forward back to this year's price action, I think that what we've seen in H1 of 2022 is really the beginning of a new regime where we think that, volatility is going to stay high. And then we think that markets can be really choppy, but ultimately they're probably going to trade kind of sideways for quite some time. So again, that's not what a lot of maybe newer investors are used to, and it can feel quite a bit different from what we've experienced in the last few years, and even probably a bit uncomfortable as well.
Absolutely. And I think it's worth noting here that the events that took place in March, April, May of 2020 feel like a lifetime ago because COVID time really truly does move at a different pace. But it's important to note that that did happen. The recovery was incredibly rapidly paced. And certainly at that time too, we had a lot of people jumping into the market to become first-time investors. During the pandemic, that was a huge trend that we watched constantly here on Public and really everywhere was new retail investors who were now getting invested. And that's exciting. But of course, there is always going to be that first big bump, that first jump in volatility, that first bear market, that first recession. And eventually you get through it most of the time. But I think that's probably what a lot of people are interested in understanding today. Now, Chrissy, you mentioned trading sideways. I would love if you could just explain a little bit more what you mean by that when we talk about this new regime. Volatility is high, markets are going to be choppy, and trading might go sideways. Tell me a little bit more about what that means.
Yeah, definitely. So I think that we probably need to get ourselves in the mindset that total returns are not going to be as high as we saw in the second half of 2020 and in 2021. So I think that there's there's such a thing as a bear market rally. So we're going to see some of these like up 10% in a couple weeks sort of periods, but that's not to say that we necessarily think that we've reached a bottom. So we think that there's going to be lots of kind of small term ups and downs, but it's not going to be as pronounced as like what we saw in 2020. So we think the trading sideways part is really that the market needs a lot more information. There's so much uncertainty on the horizon that I think that, the market is kind of in a wait and see mode. So we expect choppiness, we expect volatility to continue, but we're not necessarily saying that like now is the time to buy the dip. Right? We don't think this is going to mark the end and then we're going to go up from here. I think that we have more muted expectations of returns in the next 6 and probably even 12 months as well.
Okay, makes a ton of sense. Now, Nick, I would love to hear your perspective here, especially from the research and content side of things. I'm curious about what we would consider some of the core causes, or maybe it could be a confluence of causes that contributed to the volatility that we saw in the first half of this year. There are some obvious choices here, but I would love if you could just walk me through kind of how we got to this point. Why did things get so volatile so quickly?
Yeah, definitely. So we kind of have a joke going around on our team that all data right now is inflation data, and that really speaks to the environment that we're in, which is the fact that we have inflation coming in and it's remaining high. And if you remember just a year ago, that wasn't necessarily our expectations. We knew that we had, this high inflation that was mostly due to supply chain shocks, but there was some reasonable expectation that it would move down in due time. Obviously, that hasn't occurred. And this is, due to a medley of factors. First of all, you have the supply chain shocks. They're still reverberating through markets in some real way. Not only that, but then you have the geopolitical volatility off of the back of the Russia-Ukraine crisis, which is adding to the energy scarcity story that we often go and talk about, and that works its way into inflation in other ways. So you have all of these kind of factors coming together that's producing this really high inflation that's kind of sticking with us. And just a reminder that we haven't seen inflation like this in the past 40 years. We've generally dealt with, a 2% inflation target, and now just this past month, we're at 8.6% year over year. So what this means is that because we have high inflation, the Federal Reserve Bank, which is the central bank of the United States, what they institute in order to go and help bring down inflation is what we call restrictive monetary policy. And that's what interest rate hikes are. That's what we've been hearing about for the past couple weeks and months. So when they go and hike interest rates, essentially what they're doing is they're tightening financial conditions. They're making it more expensive for companies to go and borrow. Now, what this essentially does when they go and make things relatively more expensive to go and borrow, it means that companies aren't going to be spending as much money. They're not going to be borrowing money to go and spend on new buildings and various things. Now, this, of course, affects us in ways such as like the housing market and ways that, we go and borrow money such as car loans, housing market, and such. But what this does is that it reins in demand. And what this essentially does is that it impacts growth equities at the end of the day. So this is the big sell-off that we saw, is that as the Federal Reserve is instituting this policy of restrictive monetary policy to tighten financial conditions, equities have sold off as a result. Now, when we talk about where this is really impacting, I mentioned it just now, which is it really impacts what we call growth equities or growth stocks. Now, these are companies that aren't necessarily generating cash flows right now. Their cash flows are far into the future. And what this means is that as interest rates rise, the way we go and model that on a financial basis is that it means that those cash flows are worth less to us now, and that companies with strong cash flows, these are the large cap quality companies that we often talk about, those are the companies that we go and prefer to go and own at this point. So you go and see companies that like tech stocks really go and sell off as a result. So that's where a lot of that volatility is coming from. While traditional companies that we know have strong balance sheets tend to go and outperform in environments like this. So yeah, I think when you go and look at the core causes, we have to go and point towards inflation and what that is making the Federal Reserve do in terms of restrictive monetary policy.
Yeah, I appreciate that. I think that was one of the most succinct and clearest kind of like cause and effect examples that I have heard in a while. So I appreciate that, Nick. Now, you bring up this idea of the specific kinds of investments that might fare better, might fare worse in the kind of environment that we saw in the first half of 2022. So I would love now to take a moment to think about how investors have been dealing with volatility. I've talked to a lot of people here on Public and elsewhere who have turned to maybe investment vehicles that offer a little more diversification, things that might be a little different from what they typically or currently have in their portfolios. And a lot of people have talked to me about ETFs becoming a lot more popular with retail investors. Can you share any insight as to what you're seeing among the ETF products at iShares? Maybe Christy, I think maybe you might be suited to answer this one.
Yeah, and this is certainly very much in Nick and I's wheelhouse both. I'll give you a couple examples, and then I know Nick has some that he can cover as well. So,
Awesome.
One thing I think that it's important to note here too is that just because the equity market is selling off, we're not seeing really large outflows from equity funds, right? So this was actually kind of surprising to us because that's not usually the way it works. Usually when the market's down, we see outflows. But I think that the thing that we're pulling out of that, or like the intelligence that we're gleaning from that, is that people are really staying allocated. It's just that they're switching what their allocations are. So like the color and the contour of what we see people doing right now is getting a lot more defensive. So maybe not playing in the most speculative and the most sort of risky investments, but kind of pulling forward some of those cash flows. And like Nick mentioned too, just looking for more quality companies that already have really strong, cash flows and revenues and balance sheets. So we're seeing things, sectors like healthcare have taken in a lot of the flows. I know we talk in our team quite a bit with lots of different investor types about high dividend paying stocks. And ETFs in particular, that I like to compare that almost as the counterpoint to those really interest rate sensitive tech stocks that Nick was talking about earlier, because dividend payers actually pull forward lots of those cash flows to the current moment, right? So you don't have to think about far off profits. You can get it right now, and that's actually really I think a lot of people find that appealing in a moment where interest rates are rising and those distant cash flows are worth less. And then Nick, I'll pass to you too. I know you're having lots of conversations on the same thing.
Yeah, definitely. I think you covered it quite well, Christy. One other thing I would go and add, and this goes back to a question that, to something that you alluded to, Kinsey, was just the fact that, what the role that ETFs go and play, especially for a retail investor. You can often go and think about ETFs, or at least I do, as just this bundle of stocks. And in bundling stocks like that, what you can effectively do is you can diversify in a really easy fashion. So instead of going out, we talk about the S&P 500, for instance, instead of going out and buying just an Apple stock, for instance, that has a bunch of volatility associated with it. Or one of the other ways you can approach it is to go and buy the S&P 500. Now, you could try to do this on an individual basis where you go and buy each of the 500 stocks that make up the S&P 500. But in using an ETF, you get automatic diversification. All you have to do is buy one item, one ticker, and in doing that, you get exposure to all of these different companies. So when we talk about, buying dividends or healthcare, for instance, or even minimum volatility funds, what we're talking about is exposure to hundreds of companies all through one ticker. And that's really the role that ETFs go and play. And I think retail investors are becoming more aware of the fact that ETFs can really go and help support their portfolio in that regard.
Yeah, and if
Yeah.
I can jump in with
Yeah, go
a
ahead.
very quick, with a really quick stat around that I found just completely eye-opening because I think, Nick and I in our world of focusing on ETFs and index investments in particular, like diversification feels like table stakes to us. But actually, when we went back and we did the research, we found that in 2021, when the S&P 500 was up by 29%, so just an incredibly strong year, as I think we all knew, more than a third of all stocks in the US actually lost money. And then if you look at that on the fund basis, so if you look at diversified investments that you could look at, it was just 2% of all funds lost money. So again, it just really emphasizes the importance of having a diversified portfolio, especially when volatility is as high as it is right now.
Yeah, that is astounding. That is quite the statistic. I had not heard that one before. Thank you for sharing that. So with all of this in mind, I think that now would be a great time to kind of take a moment to look ahead, to try to see what we might expect in the second half of the year, knowing what happened in this first half, looking at some of the causes that you referenced in the first half of the year in terms of volatility, often inflation, geopolitical concerns, supply chain concerns, et cetera. Are there any indications that these might be resolved or perhaps in a more opposite effect, exacerbated in the second half of the year? I guess, what's the expectation for volatility moving into the next 6 months? Are the causes the same or different? And do you expect any of the causes to disappear or to get any worse?
Yeah, I think that you've really hit the nail on the head with this one, right? This is kind of the $1 million question at the moment. I know Nick talked a bit about inflation and then the required Federal Reserve response to that inflation. That's the biggest unknown that we're facing in the market right now. And unfortunately, there isn't like a near-term solution for that. So what the Fed has said is that they are going to be highly data dependent and that they're going to watch and see how monthly inflation data comes in, and they're going to react, accordingly. Where the market expectations are right now is that the Fed is going to have to raise rates really aggressively for the rest of the year. So I think that we're looking for potentially that inflection point for when the Fed can actually pause and say, okay, what we've done so far is a lot. Let's stop raising rates for a moment and see how the rest of the economy sort of reacts and see if inflation comes in on its own. So for us, it's really more about the end of the year. That's probably when a lot of that particular macro uncertainty is going to work its way out of the market. And then the other really big factor, which I know we touched on, is just the geopolitical volatility. And that part's really hard to tell, right? I know, obviously Russia-Ukraine crisis is still ongoing. And the way that that's impacted energy prices, we can probably all feel just in, everything from gas prices and airline tickets. So that's another really big unknown that we just don't have a lot of insights into right now. So that's part of the reason why, we're encouraging investors to think about their portfolio with the assumption that volatility is just going to stay really high for probably the rest of the year.
All right. And I think that this is, an important point to note here, that the Fed can only do so much so quickly. These have to be, for all intents and purposes, pretty incremental moves, despite the major effects that they have. Those effects typically are not felt immediately. So this is sort of it's such a trope at this point, but a wait and see kind of moment for markets. I imagine we will still be saying that toward the end of the year as well. Now, one of these other big themes that is incredibly buzzy, right up there with inflation and interest rates, the potential for a recession. We've talked a lot here on Public about the potential for the Fed to nail this soft landing, to use the policy tools that it has in its toolkit to rein in inflation, to slow the economy down to the effect that it needs to be slowed down without sending the United States economy into a tailspin, and a recessionary tailspin at that. I'm curious, though, if that doesn't happen, if a recession is on the horizon here, how might investment strategies change, especially for retail investors? And, I know that this obviously depends on individuals and their goals and their investment goals. But are there any kind of general strategies that you see that might be a great way to potentially work around or work through what might be a recession in the next several months?
Yeah, I can take this one. So first of all, I'd just like to reiterate that our base case is that, a recession isn't likely in the next 12 months. We think it's definitely a possibility. Again, we always joke around that a recession is sort of inevitable. It's just a matter of whether it'll come in the next 12 months or in the next 5 years. You don't necessarily know. But our base case is that we're not headed for an immediate recession. But with that said, I think you're right that if the Federal Reserve continues to go and hike interest rates, inflation stays high, they might be forcing the U.S. economy into a recession of sorts in order to go and tamp down inflation. So in that scenario, the way we generally think about it is actually sort of a step down procedure in which we go and step down in risk and we step down in our exposure to the market overall. And what this does is it helps us to go and reduce our equity volatility. So what does that mean exactly? Well, the first thing you can go and do in your portfolio is to go and move towards defensive sectors that tend to go and perform better during a downturn. Again, this is a bit of on a relative value basis, so you may still be down on the year, but not as down as much. These are places like healthcare, utilities, and quality companies. Those are those large cap companies that have positive cash flow, that have really strong businesses that will go and remain in place during a downturn. The other thing that we can go and do is the next step that we take is to go and reduce volatility in our portfolio. And what that means is usually the way we talk about it is what we call minimum volatility ETFs. And these are ETFs that have broad exposure to the market, but really go and focus on those companies that price stays fairly stagnant. They don't respond to the broader economy as dramatically as something like a tech company might. So that's one way. It's in your equity portion of your portfolio. It's going to reduce volatility. First move to defensive sectors and then move to minimum volatility strategies. The other way, which is a bit more complicated, is what we call reining in duration. And this is mostly if you have a fixed income portion of your portfolio, which I don't think many of you have. But if you do, one thing you can think about is moving into fixed income products that may not be as volatile. But for the most part, especially as a young investor, what you're really going for is exposure to the market, and you want to go and remain invested in the market at the end of the day. So it may be tough in the meantime, but at the end of the day, what we will see eventually is a rebound. We do think that even if we do head for a recession, reduce volatility in your portfolio, but remain invested in the market, because at some point we will start moving back up.
All right. And Christy, anything to add to that?
No, I think that just to underscore what Nick said there at the end is that like our North Star here is staying invested, because kind of the worst thing that you can do in a recession is sell at the bottom and then try to get back into the market once it's already gone up. So nobody can perfectly time the market. It's more just about getting a little bit more defensive for sort of the headwinds that are coming, but not to get out of the market altogether.
All right. And there you have it, folks. With that, I think we are teed up for a strong second half, major volatility or not. We have these strategies, these tools at our disposal. So thank you guys so much, Christy, Nick. I really appreciate you joining me on Public Live today. Such fantastic insight. Thank you so much for your time.
Thanks so much for having us.
Thanks, Kinsey.
All right. And thank you to all of you out there for listening. I hope you enjoyed as much as I did and that you have a fantastic rest of your Wednesday.
If you would like to see more content like this, subscribe to our channel and download the Public app where you can listen to these sessions in live time.